and do what we can to continue the mission there of the diocese. Additionally, we serve, you can see, well, you probably can't see because it's kind of small, but we have slides in your folder that you can see maybe a little bit better. But we have three main areas where we serve. So we serve through community services. The main one that you probably recognize there is our Catholic appeal, offertory enhancement, and those sorts of things. We've also got investment and asset management. So we've got assets under management with donor advised funds, endowment funds, and we make sure that those are Catholic compliant, that they meet the, they don't go outside the bounds of Catholic social teaching. So then the third way that we serve is through the donor services team. So I'm part of the donor services team. Madeline, who spoke last week, is a member of donor services, and Diana, who we have in the back, is also in our donor services team. And we, one of our main things that we do is we put on seminars like this. We want to help you. We want to serve as your guide on your philanthropic journey. So, in addition to advancing the cause of the Diocese of Orlando, we're also helping you meet your goals, your planning goals, whether your tax goals now or for your estate planning goals. We are here to, help you find a way to meet those goals while also passing on your legacy of faith. So before I get too far in, I just want to bring up Paul Bosley. Paul is a parishioner here and has a story to tell, and then about how you can make an impact with your giving.
Thank you. Good morning. Happy St. Patty's Day. As he said, my name is Paul Bosley. I'm the chair of our finance council here at St. Patrick's, and bringing these programs, this is our 5th year. It's a ministry that I decided to introduce here at St. Patrick's because the parish that I was with prior, Assumption Parish in Pompano Beach, when I was the finance chair, we had quite a few people that remembered the church, to the extent that we even were able to build a new parish office and a rectory from gifts from people that had remembered the church. On a personal level, when I became the chair of Assumption Church, I went to the ICSC convention, the stewardship conventions that are out there, and it was interesting. Before I took those courses, I used to think that, geez, I worked real hard for my money, and it's my money, and I do what I want with it. And, I'm kind of an Irish ex-rugby player, kind of a fitness guy that was pretty protective about all my assets. And one of the things I learned as I took the classes is that we're really stewards of what we're given and what we earn, and we're to share that. So it really changed the way I think and the way I look at things. So I started tithing. And I really enjoyed that. It's like exercise. The more you do, the better you get at it. You don't get a whole lot out of just sitting up and doing 20 push-ups or 20 sit-ups one time. But when you do it every day, it makes a big difference. And I've been tithing for years. And we already had a will. We have a family trust that we had created. So when I learned about this, I did something that was really simple. It took me probably 5 minutes and didn't cost a nickel. I just remembered our church, this parish, in my retirement account and my checking account. So what you do is you fill out a form and just put down where you want the money to go, and God takes you home. So I just wanted to share this with you because it's I think it's important that we think about, obviously, what we want to do to leave money for our children and the people that we love, but it's also important to remember the church and where we come to worship God and to pray and ask for help when we need help. So I just wanted to share this with you. I hope you enjoy this seminar, and I hope you get a lot out of it. And that's why this is why this is here. Obviously, there's no obligation on any part. It's just here to educate people so that, you know, you go home and you pray about what's best for you and your family and for your heirs. So thank you for your attention, and I'm going to hand this back to Charlie.
Thank you so much, Paul. So now our next speaker this morning is Ryan Plank. Ryan is Vice President and Wealth Management Advisor with Kodum Wealth Management Group in Winter Park. And Ryan is a member of the Plan Giving Advisory Council with the Catholic Foundation of Central Florida. And the Plan Giving Advisory Council, if you're not aware, is a group of Catholic professionals who serve as a resource in the area of planned giving. So they are here to serve you and help, again, with your giving needs. So please welcome Ryan Plank.
You guys hear me okay? Perfect. Well, thanks, Charlie. Thank you all for having me. My name is Ryan. I'm a certified financial planner. I am not an accountant, but I know enough to be dangerous. So if people have questions, I can try to address some general items. My goal today, if people were comfortable, you can ask questions. If you don't have any questions during the group session, I'm be available afterwards. But yeah, I'm here to be a resource for whatever you guys might need, and I'm going to focus more on the planning side of things. So a little bit about me. Charlie already said it. I'm a Winter Park native as much as you could be, second grade on. I've got 3 children. Bella's going to be 17 next month, which I can't believe. She went through St. Margaret Mary the whole way. My middle daughter, Ava's in 8th grade. She also went through Margaret Mary. And then our son, Caden, is in 2nd grade at Margaret Mary. And it's nice because my office is down the street, so I can run back and forth to the school or whatnot. My wife, Amy, and I went to high school together. We didn't date in high school, but that was always fun at high school reunions. And she and I, for a period of time, through St. Peter and Paul and a little bit through St. Margaret Mary, were part of the marriage prep program. So we got a lot out of that. Just with the juggling act with kids, it's been a little bit tougher, but quite involved with the church, both through the school and whatnot. So today, and I apologize, hopefully you guys have this, my goal is not to go through each slide. I really don't want to bore you guys with boring slides. Nobody likes that type of stuff. So I'll try to interject with things that I think might be helpful. We do focus on planning, goals and planning. Everybody's situation is different. I am not going to talk about products or investments. It's not about one mutual fund or another. But if we do talk about investments, my one lovely disclosure is, of course, investments are not insured. They're not guaranteed, and they can lose value. And as we've seen with some of the Russia stuff, they can lose value, but they can also come back up. So for today, like I said, I'm with Merrill Lynch, which is part of Bank of America here in Winter Park. Well, not too far away in Winter Park. And that's the disclosure, so thank you, Diana, for keeping that up. The next slide really is kind of just a keystone slide. Is your plan is at the heart of your ambitions into action. So everybody's plan is different, everybody's goals are different, but you have to have a plan. How do you know if you're progressing towards your goals if you don't know if you're on track? Good example, I want to go out to California and I'm going to drive. Well, I need to go west. Well, that doesn't really help me. How far do I need to go? When am I going to stop? Things of that nature. So having some sort of plan helps you take account for where you are, where you'd like to go, and then your steps towards that. It's also a reflection of what you want to achieve. Some people have aspirations for gifting. Some have children that might need more help. Some people have family members with health issues. Every plan's dynamic. And estate planning, the word estate is everything you own. It's real estate, it is intangibles, it's money in bank accounts, it's stocks, it's mutual funds, things of that nature. So estate planning in general, you know, having an estate plan, it's not just having a will. Because I've had a lot of clients where, oh, I have a will, I'm fine. And then somebody ends up in the hospital incapacitated, and all of a sudden they realize they didn't have a durable power of attorney or a healthcare surrogate. And then somebody's left making a very tough decision with regards to somebody's care. And it's maybe not the way that person intended it to go. So my 2 cents on that is it doesn't take a lot, but consider getting an estate plan, which does not only include a will, but a healthcare surrogate and a power of attorney, because I've seen good and bad with regards to that. On the next slide, again, I mentioned this, everybody's focus is different. Some people are younger. They're thinking about buying their first home. Some are very focused on giving, taking stock of what you had and what you want your money to do after you're gone. Health issues, like I've said, whether it's somebody who's young with health issues or aging into health issues. My wife works for a retirement community and she's been involved with it for a decade. So some of the stories you hear about how much healthcare costs and long-term care planning, sometimes we try not to talk shop, but it can get a little overwhelming, but it's very eye-opening. Below that, family, like I said, whether it's trying to grow a family or taking care of extended family, leisure, who doesn't want to maybe go on vacation now that COVID's getting better, and then last but not least, work, maybe starting your own business, things of that nature. So the goals are varied. Everybody's got different goals. As I said before, focusing on progress towards goals, some goals are a marathon, some are a sprint. A younger family that wants to buy a home, that's a shorter time frame. Different steps to hit that goal. Somebody's got 30 years to retirement, very much different goal. So again, it's just very different, and everybody's approach to hitting those goals or talking about it might be different as well. Any questions from anybody thus far? Okay. Oh, go ahead. We are. So certified financial planner, good question. She asked if I'm a fiduciary. So certified financial planners are fiduciaries, which basically means client's needs comes first. The way I also like to talk about it is, like I mentioned earlier, I don't push insurance. I don't push annuities. I'm not saying that's bad, and I'm sure there's people out there that do it, that can do it in the right way, but we're product agnostic. So client's needs come first. We're very transparent with our fees. We're very transparent how we work with people. And we got to make sure too it's a fit. I always joke, it's not an arranged marriage. Somebody comes in and says, hey, I want to live on $1 million a year, and we look at everything and go, okay, got a problem here. So we're very upfront and honest too about how we work with people. Good question. Follow up or another question? I'm in Winter Park, right near Rollins College, right down the street from St. Margaret Mary. Winter Park, right near St. Margaret Mary, and it's about 20 miles, closer to center of town. Orlando, I should say. Mm-hmm. Yeah. So his question was planning and the time frame to hit certain goals. So again, everybody's situation is different. So in terms of somebody who's older and gifting is in there, it's never too early or too late to try to address any of these. Now again, that's an extreme. Could be extreme examples, but I think if what you're getting at is in terms of like gifting at certain stages of life, it's never too late to think about that in terms of bequesting accounts or setting beneficiaries on assets. Did that answer your question?
Reality says you're only going to live so long, so
correct.
you're no longer in the 30-year plan.
No, you're exactly right. So like I told you my story, 17, 14, 8. I have somebody going to college in a year. I've done the best I could, but I know I got somebody right behind her. We also bought a car during COVID and then the car insurance. So the juggling act can be very difficult, especially early on, but you are exactly right. I think priorities can shift, goals can change, and once I love my children, but once they're kind of off the payroll, then my focus, even though it's already there, because I do have a will and I do have an estate plan, I'm going to update it. It's not a set it and forget it, just like financial planning is not set and forget it.
I thought that way when I was your age. Now my kids are all out of college and all successful. Now I'm thinking grandchildren. You know, I mean, that could be another cycle all over. So
Of course,
you have to
college
balance
planning.
that, you know. At what time does it stop? And the great-grandchildren, if you live that long.
It might never. I mean, until you're called to the man upstairs, nobody knows when that's going to happen. So that's why I say, like, I've seen horror stories where people had all in good intentions, but unless an account is actually titled a certain way, or it actually got put into a trust, or that beneficiary actually got listed, yeah, it's got to be put into fruition. But you're exactly right, because we get a lot of questions. Once my kids then have children, hopefully they're successful, and then they won't need any help from mom or dad. But somebody always made a joke, and again, I'll be 46 this year. I know I'm still young. My older clients will tell me, your kids never really go off the payroll. And I'm making that tongue-in-cheek. I mean, we love our children, but like to your point of trying to balance all the goals, if they needed help, we can do whatever we can for them. And that could also be grandchildren for 529 college planning, healthcare issues, things of that nature. It's a great point, great point. So getting back to, on the next slide, so this is a little bit harder to see, and again, I'll be general here, but as we all have seen the news in the past couple months, nobody could have expected this whole Russia situation to happen, and it's horrible. It's been, even the financial industry, all the different firms, and we're devourers of information from everywhere. Nobody thought Russia was going to invade Ukraine, so it caught everybody off guard. And then oil prices, so it was very challenging with regards to looking at history to see, do we have a guidebook to see, well, what happened before that we can maybe predict what happened this time? Never have we come out of a pandemic. Never has the government flooded so much money into the system to help keep everybody afloat. Then you have almost the start of potentially World War III, and you have high inflation. So there's no guidebook. So this slide's up here to really try to address the emotional, or what we call the behavioral finance, which can be a big challenge. I've got money in the market too. I try not to look at it as much, even though I'm in the business. I'm looking at everybody else's stuff all day long. But this is getting at trying to have that plan and staying focused on that plan, because in 08 and 09, during the great financial crisis, a lot of people just liquidated everything, which was probably not the best idea. And then when they did decide to get back in, they had already missed on the upswing of getting back. So this slide is really just to focus on having that plan and trying to not let emotions dive too much into your plan or dictate your actions. And the best example, like I said, is what's happened recently with Russia and Ukraine. The next one, again, it's a little bit smaller, but I just alluded to it, discipline process. If you can try to set goal marks, it's like that roadmap, trying to get from point A to point B to point C, and if something does curveball at you, like interest rates or inflation or again, that's on the financial side, but then family things can change. A spouse can die, a job can be lost, an inheritance can happen. I mean, there's so many different things that if you can have the main part drawn out, then if a curveball does occur, you kind of have a stepwise approach of, okay, if this happens, then this is what we can do. It's not set in stone, but having something to at least guide you is half the battle. But it starts with what matters most. Everybody's goals are different. Your own path, your own plan. Again, we're plan driven, we're not product driven, so we start everybody with a plan. Then we try to put that into fruition, and then from there we help track it, because how do we know if we're doing a good job for the client, or if things change, it's going to have to pivot a little bit as time goes on. The next one, this is a pretty good one because it gets into planning again, but goal prioritization. Good point. So most people that we work with are building their nest egg to retirement, or they already are retired. So they're trying to accumulate or then have those monies last to then support their lifestyle. Part of that could be, though, paying for a child's education like myself, and then also trying to build up the nest egg. Those are essential. I have to have money to pay the bills when I'm older. I can't rely just on Social Security, and I do not have a pension. And many people that used to have pensions, those companies are not providing them. So essential goals, living expenses, healthcare expenses, again, everybody's prioritization is different. Then you have important goals. It's kind of like telling my children needs versus wants. Oh, I have to have that new iPhone. Do you really need that new iPhone? So it's just trying to prioritize and help them realize what's important, but then bigger picture for financial planning, same concept. And then the last one is aspirational. It's things that everybody has a bucket list. They'd like to go to, my 17-year-old wants to go to Bora Bora. Why? I have no clue, but I guess the pictures she's seen online look phenomenal, but I'm thinking of it, it's a beach, so just go to the Bahamas or go to a coastal place here in Florida, which we do. On the next slide, again, this is kind of just a similar thing, laying out the plan, laying out the path, Everything is customized. There's no cookie cutter, but it's exploring scenarios. It's looking at pros and cons of making that decision, because you cannot necessarily achieve every single goal at the same time with the same likelihood of success. So you have to prioritize those and then look at the trade-offs. That may mean one goal has to be put off for another goal to be achieved, or you know, like the new iPhone. Maybe you can't get the brand new iPhone. Maybe you guys could get one that's a couple years old or one that's used. It's just a trade-off. These will probably go faster through the next two, because this is kind of specific to us, and I don't want to be product specific. But if you do ever decide, or you currently have a financial planner or somebody you're working with, I like the what-if scenarios, because this whole Russia thing happened. We have scenarios built in, and with the power of computers and software now, your financial plan should not be a 200-page 3-ring binder that is covered in dust that you don't look at. That's just my viewpoint. It's a living, breathing document that should be updated as your life changes, or as you do reviews with potentially whoever you're talking with or reviewing. But we have different software, but I really don't want to focus too much on just what our software is at Merrill Lynch. The next one, you can go again, another one. So again, same thing. Our job as planners is we're kind of like the quarterback. We do work with CPAs, we do work with estate attorneys. We try to help explain complex terms and not make people's heads spin with delta and bond convexity and things of that nature. We could get into it, but a lot of times it's just, what is my plan? What are my goals? How am I tracking towards those goals? So the whole intention of what we're doing is very goal-driven, very specific, and then just tracking that routine periodically to make sure you're on track. I kind of mentioned this next one already. Again, plan-driven, having a strategy in place, helping you feel like you're part of the conversation. If a client came in and said, hey, we have no idea what we're doing, we could set it up for them, but I actually don't like that. I like it. We need feedback. We need to have people tell us what they're looking for. It's not what I want. It's not my money. I'm helping you grow your money or do what you intend to do with that money. And part of that obviously could be gifting and charitable giving. The checklist one on the next slide, it's kind of harder to see, and if you guys can't see it, I heard a joke out there. I don't know what it was with COVID, but my eyes, I've now needed readers at home. I don't know what happened, but all of a sudden, like, my eyes stopped working. But the second one I like a lot, especially in light of what's happening right now in the world: staying invested, adjusting and rebalancing, try not to make rash decisions, emotionally driven decisions. And I'm not even talking about Ukraine, but I've had spouses of clients pass away unexpectedly, and then there's this knee-jerk reaction of almost like panic. And I always tell people, my rough rule of thumb is, let's try not to make any big decisions for at least 6 months, unless it was kind of written out and you had full intention. But if there's not confidence and it's an emotionally charged decision, it may be the right one, but it could also be one that's regretted later. So we try to guide people, and we kind of put on the counselor and the therapist hat to help people kind of just balance what their first reaction is, and then we try to let the dust settle and kind of help them out on a personal level of, you know, what do we need to do to get you to your next steps. After that, it's just really my information, and I do have some business cards, but again, if I talk too long, I apologize. I can get on a roll. Good questions so far. I really appreciated them. Does anybody have anything? And what I'll say is, I'm more than happy with general questions. If it gets too specific, I try to address it generally, but I also don't want to dive too much into somebody's personal situation. We can do it later.
Brian, on page 16, you have a slide that we can't really read. It's evaluating how well your goals are funded.
Uh-huh.
And it has a chart. How can you talk a little bit about how you would evaluate how well our goals are funded? What would you bring to the table? What would you talk about?
Great question. So the question was really, how do we evaluate if we're on track to hitting goals? So we rely a lot on computer software, and there's something called Monte Carlo simulations. Monte Carlo has nothing to do with gambling, has nothing to do, that's always the joke. But Monte Carlo simulations basically look at history, and they look at all market scenarios, and they say, okay, out of 3,000 potential scenarios of the market doing this tomorrow or doing this tomorrow, they look at statistics, and then we put that on, we have to get basically an inventory. What do you have, and what are you trying to accomplish? So I made the joke before, somebody comes in and they have this much money, but they're expecting $1 million a year out of it. That's not going to potentially happen. So to answer your question, whatever that goal is, we look at it, we look at the time horizon to hit that goal, because that's a major factor. And there's really 3 main factors. We're only control, I don't want to say the word control, we're only really impacting greatly one of them. Those 3 factors are time between now and to hit that goal, rate of return, which we do have some impact on, but if I tell you you need to be aggressive and you're conservative, that's not going to fly, because if just what happened with the market, you're not going to like it. So rate of return, and then the other one is how much you're really starting with at the dollar amount, meaning I have this much to start with. Can I add to this to achieve that goal, or is this all I've got? And then we run scenarios on that to look at a likelihood of success. And in our business, whenever we run retirement income, we try to look at Social Security, inflation expectations, pensions, liquidating a business, selling a second home, and then we basically put it on there. When we do planning, I like to be at 80% confidence interval and above. That's just my personal. 50%, if you remember from math classes in high school, is the bell-shaped curve. So 50-50. I need to have higher confidence, because the last thing I want to tell a client is, congratulations, you're 65 or 68, and yeah, you're not done. You got to work a few more years, or we always make the joke, no offense to anybody that's worked at Walmart, but you're going to have to go back and be a Walmart greeter. I mean, that's a bad joke to use, but the higher degree of confidence, then you can weather a market up or down, or we're relying on statistics and history. And then any planner should talk to you about like some of the flaws in that. Some of our software assumed cash was going to earn 2.5%. Cash has not earned 2.5% in probably a decade. Now it might with inflation the way it's going, and if the Fed keeps raising rates. But to answer your question, we rely on some software and analysis, but everybody's situation is different in terms of where you are now, what you're willing to do with it in that time frame, and then what you're trying to achieve at the end. Good question.
What are your thoughts on inflation?
It's a good question. My thoughts on inflation. So normally, anytime you print a lot of money, it typically causes inflation. I do think the government is in a tough spot because inflation can be driven by supply-demand. So there's less of something being made, but more people want it. So that's going to drive the price of that up. That's inflation. Pumping more money into the economy can cause inflation. Oil is in some metrics for inflation, others not, but then Russia happened. So the Fed's in a very difficult spot with inflation right now because we do not want a hard economic landing or pushing the economy into a recession if they do it too quickly. But they had to do something. And I'm not a monetary theorist, but I would tell you that I think inflation's high. I think the government, in my opinion, is probably underestimating how long it may last. People have different opinions. They think it may be transitory and not be as bad or as long. But as you guys have seen, everything's costing more right now. And I think until some supply chain issues get fully addressed with COVID, which I don't think have happened fully yet, oil, the whole Russia, I keep hearing how the United States can be energy independent, and we can be, but they can't just turn on a switch and all of a sudden pump out all the oil that's up in, fracking. That's apparently we can get out of the ground, but it's cost $40 a barrel to get out of the ground, and it wasn't profitable until now. So I think there's a lot of factors. So my main opinion is inflation's high. The government is going to have to raise rates. That's one of their major tools to help combat it. My concern is how quickly and how often, but they just did the first rate increase yesterday, 25 basis points. If this Russia thing hadn't happened, they probably should have raised 0.5% yesterday, just to kind of help get it in check. Because inflation in my working career hasn't been this high that I ever remember.
Al's not doing enough. He should be doing more, and should have been doing more.
See, again, no, and he made a comment that Powell should be doing more, and I don't get political. I try to stay middle of the road. I see both sides. I get it. He's in a very tough spot. and we look back at history, and I'll say two quick historical things I saw from two different investment firms. One was looking at geopolitical events, and they looked at the past 8 geopolitical, the Iran hostage crisis, when Russia invaded Crimea. My impression was those must have been really bad and set the tone for a recession. Well, 7 of those 8 times, the market was positive 6 months and 12 months later. So I was like, oh, that's interesting. I would have thought the opposite. The other really interesting one was the Fed raising rates. And I thought, oh, well, when the Fed raises rates, the market's got to not like that at all. Past 13 times since the 50s when they've gone through a rate hiking cycle, 11 of those 13 times the market has been quite positive over that hiking cycle. Well, what does that mean? Usually it means the economy is doing well enough to take on that rate increase. So again, I'm trying to rely on history a little bit, but I made the joke before, there is no guidebook. They've never pumped so much money. We've never come out of a pandemic. We didn't have this thing now with Russia. It's very unique. So that's like, it all goes back to planning. It goes back to the lovely pie charts with diversification, a little bit of this, a little bit of that to help smooth out the ride. But I could go on and on and on. And unfortunately, none of us have the right answer. And I hate to say this, a lot of times we won't, it's a ripple in the lake. They'll do something with rates and we may not feel that full effect for 3 to 6 months later, because the recession, if it does happen, doesn't happen. Oh, we raise rates, boom, we're in a recession tomorrow. It's in the rearview mirror. We may not know we're in a tough spot until after that. Good question, though. Wish I had a better answer. If I did, I wouldn't probably be standing here right now. Yes, ma'am.
How do you preserve your assets and yet stay with inflation?
Good question. So how do you preserve your assets but also stay within inflation? That is something that keeps me employed. I mean, it's very tough to do because cash in the bank is earning nothing. You're not keeping pace with inflation, unfortunately. I've got a lot of clients that are older, more conservative, so everybody's goals are different. Some people want preservation, and they don't care about inflation. Some people want protection, but keeping pace with inflation. I don't want to get too specific. One of the best asset classes to try to keep pace with inflation is stocks. Now, I'm not recommending those for you, but stocks and the equity markets have the potential to do better in a rising rate environment. Bonds are typically on the flip side, and again, I don't want to get too far, but there's bonds that mature in 1 year, there's bonds that mature in 30 years. Remember the teeter-totter from in the playground? The shorter you are on your bond, the less interest rate moves can change the value of your bond. The further you are out, the more an interest rate moves. So what I'm trying to get to you is it's having a little bit of every asset class that's appropriate for your risk profile. Unfortunately, cash and CDs, and that's the other problem. The Fed raises rates. I haven't checked yet this morning. Banks don't turn around the next day and raise rates. They typically give it some time. Even if they did, you're probably not maintaining your buying power with CDs right now, unfortunately. But if your goal is preservation, and FDIC insurance, because those are backed by the government, up to $250,000 per individual and $500 per couple. Again, that may be the way to go. Just to, if that helps you sleep better at night, then have a CD. But if you're willing to take some risk, and to answer your question, how do you preserve it, or at least the buying power? You may have to look at adding a little bit of slivers of that, bigger picture to help you keep pace, but also take an appropriate amount of risk that's right for you.
And the stock goes down, you're in a certain age, you have no time to recover from that.
Yeah, so she basically said when you're in stocks and stocks go down and you don't have the time for it to come back, and that is true. And that's why stocks are different. There's Microsoft, there's Netflix, high growth potential. Then there's Walmart, McDonald's, things that pay dividends. You are correct. So the danger then in what we do is if somebody has too much risk or too much stocks, they can't weather the storm. If they're dependent on that income or withdrawals, in my opinion, it's like the bucket approach. I like having a client with a bucket of cash, so if something does happen with the markets, I have a cushion. I have a pillow to help you weather this storm. We pull from the safe money. And then hopefully over time, this bucket comes back up, and then we replenish a different bucket. Now again, I'm not saying that's correct for you, but you are correct. You don't want to have too much risk or too much concentration either. We have a lot of retirees from Disney, Lockheed Martin, and you've heard the term drinking the Kool-Aid. They're like, oh, my company can't. Well, ask the people that worked at Enron. It just, you know, the oil company in Texas, they lost all their money. It can happen. So you're correct. Don't have too much risk. Uh-huh.
What is your view on precious metals?
What is my view on precious metals? I'll be brief. I don't want to get too specific. I think of precious metals as gold, silver, palladium, platinum. It used to be in the past gold. When we got off the gold standard, gold would act opposite of the market. It was an inflationary hedge. It was a safe haven. In the past few years, until recently, gold really didn't do what it was supposed to do. Now things have changed even more. Well, now metals aren't used as just coins or precious metals. They're used in electric vehicles. They're used in all this new technology where the metals are now, they have a different intrinsic value because they're being used for other things. I know right now, like nickel and cobalt and lithium, they're not the easiest metals to get out of the ground, but they're critical for what probably will be a less oil-dependent world and more on electric and solar, which I'm all for, but I also know it's very expensive and very dirty to get a lot of those things out of the ground, so there's some environmental concerns as well. Something else I should have brought up, because you did with the Catholic Foundation, we also do environmentally, ESG is the term, environmentally conscious, socially conscious, and governing. So investing has changed a lot where the world has shifted more towards, you know, you don't want tobacco stocks, you don't want alcohol stocks, casinos. So we also have that ability to, and actually have quite a few clients that have now been asking for that specifically. But getting back to your point, it can be part of the overall, but the other thing I'd say real briefly is, if it's a hobby and you like the coins, by all means do it. But there's also some danger in storing it in a safe. And then when it comes time to liquidate that to cash that you need to pay the bills, you're probably gonna have to pay somebody to do that. They may not give you 100 cents on the dollar. So there's some trade-offs in the cost of what your exposure and how you're getting those precious metals. Good question, and yes, we do believe in commodities to have a hedge, but again, it's all in relation to everything else you have. Go for it.
Some thoughts on real estate and what's going on with that?
Well, real estate is, just look in your own neighborhood, I mean, holy moly. I don't know if we're getting close to a peak. I think what happened with real estate in 08, 09 was more of an over leverage where the banks were kind of part of that problem, or they gave people a lot of loans that maybe shouldn't have qualified for loans, and then they couldn't afford them, and then everything collapsed. For a while during COVID, office real estate was horrible. Nobody was going back to the office. And all these vacation properties were increasing magically because nobody was going to go back. They're just going to work remotely forever. So it's a good income source. I'd say just be careful in what you're owning in that. Like malls, Simon Property Group is a great big shopping mall. I think Altamont Mall or maybe Mall of Millennia is Simon Property Group. Again, there's certain sectors where you got to be careful how much you're exposed to certain parts of the real estate market. Rental, multifamily units versus condos versus office, commercial, industrial. If you own an Amazon warehouse and they came a knocking, you basically won the lottery. I mean, there's such a demand, and now everything costs so much to build. So it's a more complicated question, but yes, it's an asset class that we would use as well, and potentially for income generation.
It seems like rents, residential rents, never go down. Mortgage rates fluctuate, but rents do not go down.
Not in my recent memory, no. So no, you're right. But again, you could be an actual landlord and rent out, and then there's some challenges there because then you've got somebody calling you at 2 o'clock in the morning because the toilet's clogged. I mean, I'm making an extreme example of how you want to own that real estate. But yes, typically you don't normally see rents go backwards, but it's all relative, unfortunately, because of inflation pressure, supply, demand. Probably a more complicated answer than what I should be giving you, but it is an asset class that can be considered just like commodities could be considered. But again, it's all in relation to your own risk profile and how much you're willing to take on. Good questions, by the way. Anybody else? I'm sorry if I took too much time. I'm good. Thank you, guys.
Thank you, Ryan. And just as a reminder, you can sign up afterwards at the table to have a free 1-hour consultation with Ryan. So if you had any questions that maybe you didn't want to bring up in front of the whole group, that would be a great time to chat with Ryan. So again, just remember the sign-up sheet at the back, and Ryan will be glad to meet with you. All right, so that was a very helpful presentation. We touched on a lot of timely topics with planning today. I just want to go through a couple of our resources that we have. Last week, we had this slide up here as well. And one thing I'll point out with this slide, you'll see those funny-looking QR codes there. Those will bring you to our webpage. So I know you won't be able to scan it from there, but you do have your handout. You can just open the camera app on your phone and point it at that QR code, and you'll see a little link pop up. And when you do that, tap that, and it'll magically open for you. So a little easier than typing up www.cfocf.org/legacy. So, but we've got two things here. We've got the legacy resources. So that's where you're going to have your Planning Your Catholic Legacy Wills Guide, your creating a family mission statement there, and the opportunity to leave your legacy of faith. You'll see that's highlighted. That's in your folders today. And we're going to talk about some of the topics that are brought up on that in just a little bit here. But again, the QR codes here, or the links, whichever way you want to go, those will bring you to those resources so you can access those later. Or if you have any questions, you've got my card. Feel free to call me or email me, and we can send any of those resources to you as well. But let's talk about some opportunities to leave your legacy of faith. So, you know, we talked about the things that the Catholic Foundation does. So we support the diocese, we support parishes and the schools and other ministries here. And we also, again, want to help you with your planning. So whether that's, you know, planning for now or for planning for down the road with estate planning. And there's some ways that you can meet your goals and pass on your legacy of faith to those next generations, or to continue the work of your parish or your local schools. And we're going to talk about just 4 of those here today. There's many more, and again, the opportunities page that you have in your folder is going to go into much more detail here. But we have the Ira Charitable Rollover, also known as a qualified charitable distribution. The qualified charitable distribution from your IRA, so that's giving from your IRA during life, and we'll talk about how to do that and why you would want to do that. We have an IRA Beneficiary Designation, so that's leaving your IRA to someone after you pass away, so that's going to be either to your family members, friends, to your local nonprofits. And when we talk about nonprofits too, one thing I want to point out that sometimes gets implied but not explicitly stated is that your local parish is a nonprofit. So, you know, we're thinking about charitable giving. You know, think about St. Patrick's, think about, you know, the school, think about, you know, those religious organizations as well that are considered nonprofits. And then we're going to talk about giving appreciated securities and giving through donor-advised funds. So let's start off with the qualified charitable distribution. So how does that work? And again, I know you can't see this up here. It's very small, but it is in your packet there, and it's got a lot of good information, so I want to make sure that gets to you. So the contact information there for if you're curious afterwards on making a qualified charitable distribution, you'll want to reference that slide. But how does it work? So if you are over the age of 70 and a half, you may give up to $100,000 each year directly from your IRA to from your IRA custodian to a nonprofit. So if we can advance to the next slide there, just to see those rules there. So again, you have to be 70 and a half. You can give up to $100,000, and it must go directly. So generally when you're taking a distribution from your retirement account, that's going to be a taxable distribution unless you have you know, Roth, and then, you know, those Roth distributions are going to be already taxed, so they're tax-free when they come out. But generally when you're taking distributions from a retirement account, it's going to be fully taxable. Well, what we have here is a way to give during life. Again, you have to have reached age 70 and a half, and you can only give up to $100,000 each year. But when you make it directly from your IRA to the nonprofit, then it comes out tax-free. Okay, so why would you want to do that? Well, you want to do that if you are over age 72 and you have required minimum distributions. If you have those required minimum distributions, then you may or may not appreciate the additional taxable income. There's two sides of that coin. So you may need that taxable income, and you want to receive the income from your retirement account. That's what you've been saving for. But you may be in a situation where, again, you're required to take those payouts after age 72, and you may not you may not need that. You may just see that as additional taxable income. Well, in those situations, the Ira Charitable Rollover, the Qualified Charitable Distribution, may be a good fit for you, to where you can send that directly from your IRA to a nonprofit like St. Patrick's here, and it satisfies that required minimum distribution requirement. So you're not taking that taxable income anymore. You are giving to your church, and you're bypassing that taxable income. Now, you're not taking an income tax deduction with that like you would with other charitable gifts, but you don't need the income tax deduction there because you're keeping that out of your ordinary income. So again, just an idea there. The qualified charitable distribution from an IRA can be very helpful in those situations where you feel like your RMDs, your required minimum distributions, are just another source of taxation for you. Now, beyond the qualified charitable distribution, I mentioned beneficiary designations. So with your retirement accounts, you have likely already filled out beneficiary designation forms designating family members, friends. Those beneficiaries, if they're individuals, are going to be taxed on those distributions from the IRA. So if you've got a bunch of different assets that you want to leave to family members and friends, and you're considering a charitable gift to your church, then you'll want to be strategic about which assets go where, because your IRA, when that goes to family members and friends, or your other retirement accounts, when that goes to family members and friends, they are going to be taxed on those distributions. But if it goes to a tax-free entity, that entity is not going to be taxed on those distributions. On the flip side, with other appreciated assets like stock or real estate, when you leave those to family members, those are going to get a step up in basis under the current rules. So with that step up in basis, they aren't going to be taxed on that. So all things equal, you have something that you want to, you want to benefit family and you want to benefit a nonprofit. You want the IRA to go to the nonprofit and the other assets to go to family, because you skip out on a lot of that taxation that would otherwise occur in those situations. So again, you could list a charity as the beneficiary, so your church could be the beneficiary of your IRA, or you could do what we call a charitable remainder trust. So charitable remainder trust is a little bit more complicated, involves seeing an attorney and having that trust set up. But it can also be helpful to fund the charitable remainder trust with your beneficiary designation, and then have that pay out to family members for a period of time. So that can pay out for their lives, it can pay out for a term of years. A couple years ago, or prior to 2020, I should say, the rules allowed IRA beneficiaries to stretch out their distributions over life expectancy. So if someone was a beneficiary of a retirement account, and they could take their distributions over a very long period of time if they had a long life expectancy. After 2020, that has been reduced to just a 10-year period of time, with the exception of a surviving spouse, and there's some other exceptions there. So a spouse doesn't fit under these rules, but other beneficiaries are going to have just 10 years to take out all of the distributions from the IRA. So what that does is that squeezes those distributions into 10 years, and it can potentially increase the taxation on those distributions. So the charitable remainder trust, the reason I'm bringing that up is that it can kind of bypass that 10-year rule. It allows a longer period of time, pays out to those beneficiaries each year, again, for whatever period you select. It's either for their lives or for a period of up to 20 years. And then after that period of time, after that trust ends, then you are distributing the trust, the trust assets are distributed to a charitable beneficiary. So there's two sides there. There's benefiting family over a longer period of time, there's the growth inside the trust, and then the charitable beneficiary receives those funds afterwards. So that's just a little bit about the IRA beneficiary designation. Again, if you have any questions about all of this after, I'd be glad to chat with you or glad to talk with you later on about it as well. So beyond the IRA beneficiary designations, we also have gifts of appreciated assets. So as we've talked a little bit about stocks, bonds, mutual funds, those sorts of things can be given directly to a nonprofit. The reason you would want to give those directly is that you are bypassing a lot of gain by doing that. So if you had some stock that you wanted to give to St. Patrick's and you sold that stock and then donated it, the cash proceeds, well, you are paying the capital gains tax on that stock before you give the cash. So you're adding a lot of taxation for yourself if you sell the stock first. So what you want to do is donate that stock directly to the church and have that go tax-free. Again, because it's a nonprofit entity, it goes tax-free. You're bypassing that taxation there. So if we could move ahead to the, we talked about this just a little bit, so you're bypassing that gain, and then you have a charitable income tax deduction as well. If we can skip to 2 slides forward. Ryan talked a little bit about the market, so I don't want to repeat that, but if we look at our Meet the Smith slide here, again, it's in your packet, probably a little bit more readable there, but you'll see those 2 roads that you can take. So the Smiths have $50,000 worth of stock. If they were to sell it and then donate the cash to their church, then they are out $57,000. So it's the $50,000 in stock plus the $7,000 or so in taxation. But if they donate that stock directly, that direct donation, they are bypassing that capital gain. So it's just $50,000 from their stock to the church. Yes, Steve? Right, so we've moved on. The question is, all of these are for non-IRAs. Yes, we've moved on from the IRA now to just general stock gifts. So these are stocks. Right. So stock in an IRA, if you have your IRA, the distributions are going to be taxable to you, and then, yeah, you're not going to be able to contribute that directly to the charity unless you fit within that IRA charitable rollover that we talked about earlier, the QCD. So if you fit within those QCD rules, then the distribution would be non-taxable. So anyway, the Smiths here, as you'll see in the chart, they're much better off donating directly rather than by selling the stock first and then donating it. So if you sell your appreciated assets before you donate, you're adding a lot of unnecessary taxation for yourself. The next thing I want to talk about is a donor-advised fund. So the Catholic Foundation of Central Florida holds donor-advised funds, and there's other organizations that hold them as well. What is a donor-advised fund? Well, that's a place where you can donate and have that donation stay and held and invested until you're ready to determine where that is going to go. So you'll donate to the donor-advised fund. You will take your charitable income tax deduction for the year. And then once you decide, okay, I want to benefit this parish, I want to benefit the school, you're able to, get in touch with us and say, I've realized that I want this donation this year to go to St. Patrick's, or I want this to go to St. Margaret Mary School. You can make that decision later, but you've given now and you've taken your income tax deduction now. One benefit of the donor advised fund is that you can bunch your donations. So if you like to make $5,000 donations each year, but with the fairly recent changes in the standard deduction amount, your donations are no longer getting you above that standard deduction threshold, so you're not really getting the benefit of that income tax deduction. You can put all of those together, make one big donation into the donor advised fund, get over that standard deduction threshold so that you are itemizing your taxes and taking that deduction, and then decide each year, okay, now this year I'm going to give $5,000 to this organization, next year I'm giving $5,000 to that one. So you can establish those distributions that way. One thing that I should bring up too is that you are advising the distributions from the donor advised fund. The organization generally is going to go along with your advice there, as long as it meets that organization's goals and requirements. So let's say with the Catholic Foundation here, again, we hold donor advised funds, and these have to be compliant with Catholic principles. So you need to have your donation go to something that is going to fit within that Catholic social teaching. That could be one of the parishes or missions here at the Orlando Diocese. It could be something we actually have a number of organizations that we have pre-approved that you can look through and determine where that distribution goes. As you see here on the slide, and as we mentioned, these are invested for growth. They are 99.3% compliant with Catholic social teaching, so we really want to make sure that everything meets the requirements of the Catholic Church. Next, we have endowment funds. So endowment funds are, here I'll just show you a little bit about donor advised fund grants. They're very popular these days. There are billions of dollars granted from donor advised funds each year. Contributions to DAFs in 2020 were $47.85 billion, and over $145 billion were held in, or $159 billion were held in donor advised funds in 2020. $34 billion granted in 2020 from DAFs. So a lot goes into the DAFs and then is distributed over time. Next is the endowment funds. So we also hold endowment funds at the Catholic Foundation, and your endowment fund is held in perpetuity and distributes earnings each year to the charitable purpose for which you've set up the endowment fund. So whether it's your church or or the school. So whatever you have set up that endowment fund for, it's going to be invested for growth. We have a $20,000 minimum there. It's invested for growth, and then it's held in perpetuity, growing and distributing assets over time. So as it grows, that impact also grows with those distributions. Lastly, I just want to bring up because I see we're running low on time here, the Vivos Christie Society. So Vivos Christie Society is our way of recognizing you when you have made a planned gift. So we've talked about a few different types of planned gifts today. That could be a bequest, beneficiary designation, could be a charitable gift annuity, charitable remainder trust. If you set up a planned gift through or to benefit the Diocese of Orlando or the Catholic Foundation, we are automatically recognizing you as a member of the Vivos Christie Society. We do have a gift notification form, so if you have remembered a diocesan entity in your will, or if you have made another planned gift, please fill out that form. Let us know. You can remain anonymous, but that just helps us make sure that your gifts are going towards the purpose that you are hoping to accomplish there. Yes?
Prioritized. Who decides? I mean, you mentioned schools, parishes, all these worthy. How's that prioritized?
Sure. So yeah, you are, when you set up the endowment fund, you are able to choose we'll work with you to choose, where that's going. So whether that's going to the church here, or whether that's going to the school, or for the purpose that it's going towards. Does that answer your question?
So the individual determines strictly, but at the diocesan level, is there a committee? I imagine there is a committee who decides. There's billions of dollars, and how this is distributed.
So yeah, I mean, there's several endowment funds held by the foundation, and each of those has its own purpose. But if you were to take, again, $20,000 or more and set up the endowment fund, and you really want that to go towards this certain purpose, then we're going to send it toward that purpose. Or you could contribute to one that's already existing and continue that. So, right. Any other questions? All right. Well, again, thank you all so much for coming out today. It's been a very informative session. Thank you to Ryan for coming, and thank you to the staff here at St. Patrick, Mary Grace, and Father Hank and Joshua. And again, please sign up in the back if you're interested in a 1-hour free consultation with Ryan. If you have any questions for us, our cards are on the table. Feel free to give me a call, and I'd be glad to talk with you more. Thank you, everyone.